Welcome to Financial Modeling and Valuation course. In earlier session, we have seen on the sectors that you have to choose and the companies that you have to choose. Now, when we talk about the financial models in real life, when you work as an analyst, you have several targets to be given by the seniors, right? So you have to go through several financial models. So we will be seeing what types of financial models that is normally used. You have the earnings model, which can be used for projecting the business performance, Then in similar way, you have to calculate a debt model, or you can say the capital restructuring model. So there will be some capital restructuring process will be taking place. We can say that capital restructuring models. Or you have the debt schedule. You can say the debt schedule. If the firm is depending upon the more leverage based firm, if it is a more leverage based firm, then we have to prepare the debt schedule. Or the investment schedule, if the firm has to invest in a particular fixed income securities, then it has to prepare the schedules. Then suppose you have to do your more with the mergers and acquisition. What is the effect given to merger of a company, after effect and the before effect? So we call it as merger or acquisition model, or acquisition model, right? So normally we have seen that banking companies have gone several mergers and acquisition has been going through till now. So you can extract the financial statement before merger and after merger. You can see how far the difference, how far the revenues that they generate. So banking, we call it as net interest margin. In the similar way, you can able to check the NPA, non-performing assets, how far the bank are recovering from it, and how far the risk-weighted assets ratio that bank is having. So because bank is following the Basel norms, now they are following the Basel III norms. They have that standardized capital asset model has to be maintained, standardized capitalization to be done with the help of the standard risk-weighted ratio, which is given by the regulatory bodies. So you can also do an well-versed analysis over there. So then after that, once you've done that, you can also go for the business valuation model. So normally this is the typical thing normally the financial model normally involves. So earnings model, normally we go from the approach is something from, we will be going from income statement, then we'll be going to the balance sheet, then the cash flow statement. Normally the approach may differ from industry to industry. If you want to go for a banking, it is normally done for the industry who is commercial in nature, commercialized industries. We can say the commercial industries. You can go for that. Suppose you're going to go for a financial institution. So first thing for financial institution, first we will be getting into the balance sheet. First we have to do the balance sheet analysis. Then we have to come to the CFS. Then we have to come to the income statement. So the picking up the data, right? Because every statement, every indicator in the income statement will affect the balance sheet, and the indicator in the balance sheet will affect the cash flow statement. So in case of the financial institution, the indicator in balance sheet will affect your CFS, and the CFS factor will affect the income statement. So it works like a cycle, right? It's a circumlocution. Then one more thing is that when we talk about the valuation, the mostly used valuation in the market is the DCF model. DCF, we call it as discounted cash flow model. So discounted cash flow model is a similar thing that we have already done in the time value of money, right? So the Modigliani and Miller model, normally we say that there is no corporate taxes, then you have some of the assumption which is given in that. So then we have to calculate the free cash flow to the firm. So this are been already discussed in the corporate finance subject itself, where we'll be calculating the cost of capital of the firm, then we'll be analyzing the leverage ratios, then we'll be doing the calculation of your earnings before interest and tax, and comparison of doing an analysis of EPIT and EBS analysis. So these are been already done in the corporate finance, so it becomes very easy for us. Then we will be calculating the economic value added, EVA. So if it comes to the merger and all, we have to see something about the synergies and all. So this can also be taken into consideration. So these are the typical things that you have to a little bit get familiar, because here we will be doing only with the earnings model, right? And we'll be doing the projecting the performance of a business. So the model gets more complex if you add the risk factor or the mathematical factor into constraint. So we will be using some mathematical model if possible for getting the models to be a little bit more complex. The most basic of the financial models is the earnings model that mostly they perform. I'll just give you the overview of a textbook of that they have done with the FedEx Corp. Just open the Excel sheet. So this is the typical FedEx earnings model. So this source has been taken from the book. I have not framed any models. I have taken the source is from the textbook, right? So they have given the source. So that is the this just have to have an overview of this. You have to see how actually the financial model looks. So here they have generated the earnings model. So this statement, this is as per your accounting standards, right? So you have to little bit familiar with the GAAP, which is nothing but generally accepted accounting principles that already we know that, right? So we normally they follow the standards or the statements, whatever the statements is been prepared as per the accounting standards. So if it's IFRS, if it is IS, International Accounting Standards, or if it is Indian as per the accounting standards, which has been issued by ICAI. So these are the statements that they have given, and these are the projections they have calculated, right? I'm just giving a quick navigation of the financial model for you, right? So just to have a glance how actually a financial model looks. So these are the expectation, these are the expected values that we have to calculate, estimated values. These are the hard code data which has been directly dragged out from the financial statement or the income statement of the FedEx Corp. They have taken it and dragged out this one, and here they have calculated the values. If here in the formula bar you find that you have added the two D15 and to D3, right? So they have done something. So here I see that they have broken down the whole income statement into part by part wise, and they have given the more granularity. So more granularity calculation of the each line items, right? If I scroll down, you find that they have done the ratio analysis for that, right? So they have done the ratio analysis, and they have done the non-GAAP adjustments also, right? So they have done the non-GAAP adjustments. So this is the overview of your financial model. So we will be working on the similar platform but with different setup, right? Now getting into the annual report. If I show you the annual report, so this is your annual report of your Asian Paints, right? So in the annual report, what we have to see is that we have to say the income statement. So this is your income statement, that is statement of profit and loss. So here we'll be doing the copying paste of the variables. Here we have to concentrate on here for this is the statement of 31st March 2021. In this you have the past year, the previous year and the current year. So current year data and the previous year data, this has to be pulled out. These values has to be pulled out into Excel, and we will be putting a format of revenue from sales. The other income has to be added with the after the EBIT. So this will be working in the Excel. Just have what are the financial statements that we require, right? So for income statement, that is nothing but statement of profit and loss. Then you have the balance sheets, right? So these are your line items. These are your line items, and we'll be taking the line items, because if we have any confusions, then we can go for further into notes, which will give you the further how it has been, this value has been derived, if it is required for us, if some adjustments has to be done. If I scroll down, you find this statement of changes in equity. Then we have the cash flow statement. So this is your cash flow statement as per AS3. Right, so just have an overview of the annual report. Download the annual report and go through the financial statement sections, right? You have the consolidated financial statement and go for the standalone financial statement. So these two are important. Just have a good glance of this, because we have to pull the individual data into the Excel and we start doing the analysis part. So we'll be doing the ratio analysis with the help of assuming a growth rate factor of 12% or assuming growth rate factor of 3%, depending upon the management's report or the independent auditor's report or the management and discussion analysis section. So they would have given some percentage depending upon the growth factor that the company is going to go, right? So this is the overall view of your financial modeling. So in sum I can say that for doing a financial model, you should be a little bit familiar with the Excel. Okay, Excel working is very important. Then you should be familiar with the accounting, how actually accounting works. Then you should have the knowledge on the accounting standards. Right? So because if you do a financial model of an US company, you have to follow the US GAAP, right? If you're going to follow the accounting standards of European nations or any company related to UK, you have to go for the IFRS. So these are very important. The accounting standards, a little bit of accounting standards you should know. Then you should know how to interpret the financial statements, right? So these are the basic thing that you require for building up your financial model. So this will be covered in my course. So step by step I have given you for whom the basics of Excel. Okay, first thing is that we have to be a little bit familiar with the Excel functions. Okay, so I have given the Excel function calculation individually, Excel functions to be known little, and how the operations, the arithmetical operations to be performed. Okay, these are very little bit important. Okay, arithmetic operations to be performed in Excel. So these are the two basic things that you have to be a little bit familiar with it. So in my course I have just given you the step-by-step recording of the lecture, so that you can watch. If you are more well versed with Excel, then no problem, you can directly get into the financial model that I have done with the step-by-step example with the help of the two sectors. One is your FMCG and one is your banking sector.